Prasun Kajri, Chief Investment Officer with HDFC Life. He joins us live. Prasun, good to have you back. Thank you for joining us. Prasun, if I map the broader environment, of late global news flow has been constructive. Institutional liquidity has been strong. Commodity prices have corrected. But markets have done precious little this year. Nifty is up only 3%.
Yeah, it's a difficult market to read. I mean, too many things happening. The moving parts are just too many. I mean, what is happening at the global level is something which is a little bit perplexing, given the way the bond yields have been moving up, especially in Japan. Locally, the bond yields have been falling and rather quickly. RBI has been trying to tone down that situation. Rupee has been depreciating. I think that has been a little bit of a worry. While dollar has been strengthening against all currencies, rupee has probably weakened a little bit more. I think that is a bit of a worry. So my sense is that why Indian markets haven't really participated as much. I think the result season has been a mixed bag, has not really given any cues for what lies ahead in FY14. Very difficult to call that earnings are going to turn around very quickly. So I think that something remains. The Indian market valuations, while are not very expensive, this result season has not given any clues in terms of when the earning upgrades can come through. So I think that remains a cause for worry.
Prasan, we've got the GDP data as well, slated to come out today, and most market rumors are indicating that it is going to be a sub 5% figure. Do you think this is really going to dent the market movement, or the market will be undeterred?
It may for a day or so, but I think that is a number which is pretty much expected. Market is expecting something around 480 or so. So if it is in line with that, maybe there is some reaction on the market for a while, but that is not going to be material. So unless that number comes much closer to 4%, in that case probably there will be some worries.
Glaxo Consumer has added 200 rupees. There is price action in Emami. Zydus Wellness is looking strong. Britannia is up 17%. Prasun, everyone on the street is of the view that consumer companies are big companies, strong franchises, great brands, but they are expensive stocks to own. So no one is buying them. If no one is buying them, why are these stocks going up on a daily basis?
See, my sense is a lot of the consumer names which are going up are reasonably illiquid names for one. Yes, they are great franchises. Most of them have given reasonable results. Nothing very special, mind you. Because some of the names, the volume story has been coming off a little bit, or the A&P spends have gone up, which has really impacted the EBITDA margins. So clearly there are concerns there, but given that these are not very widely held, a lot of these are illiquid names, and there's some relative catching up of the mid caps compared to the large caps, because large cap valuations have really gone through say 30-35 times. So some of the mid caps are really catching up on the valuation differentials are narrowing. I think this is what is driving. It's a very difficult call whether you want to be in these sectors or not. Obviously it has paid off to be a part of this sector and owning these stocks, but when it reverses is very difficult to call. So it's a very difficult call as an investor to make as to what kind of a position you want to maintain on FMCG stocks at the point of time.
Prasun, tempting as it may sound, but should one still avoid buying into infra and cyclicals, because clearly government promises have not morphed into reality for these companies?
I would agree with that. See, my worry is, and that has been the case for a while now, that unless we start seeing a reasonable revival in the capex cycle or infrastructure development back again, these names will continue to languish. They still have balance sheet issues, mind you, and if the order flow does not really come through in a very big manner, that balance sheet problems are not going to go away in a hurry. So clearly I don't see any green shoots as far as the capex cycle is concerned. Very minimal maybe, because the government project data, what we have seen is seemingly holding on. There's a minor uptick in the private sector capex, but nothing meaningful to write home about. So until one sees some meaningful change in that parameter, my sense is, given the state of the balance sheets in some of these names, we would probably avoid the sector as of now.
Prasanna, how does one approach the auto space? Good numbers from the likes of M&M, Maruti, where the yen weakness has augured well for the stock. And then, of course, Hero MotoCorp as well turning around, as was the case with Tata Motors. Is it time to buy into these names, or do you feel that this is just the start of a rally, or is it just a one-off move according to you?
See, my view is that the expectations from some of these names had come down given the fall in the monthly numbers and the monthly sales numbers. These companies have surprised on the margins very clearly. Whether that is sustainable or not is difficult to answer. So my view is the stocks will react to the monthly data numbers as we go along. So in 2 days' time we'll have, but tomorrow we'll have some of the numbers. My own view is I think the slowdown is still continuing. The competitive intensity in some of these sectors is still increasing. So I would not be extremely enthused. These stocks are no longer cheap. I think they've rallied reasonably. So while one would want to be invested in some of these names, I would not want to go significantly overweight in either of these names. Clearly because I do not believe the slowdown cycle is completely over either in the CV side or on the four-wheeler side or on the two-wheeler side. I think that could continue for a while.
So Prasanna, based on how globally things have moved this year and how locally things could move in next 6 months, have you changed your portfolio strategy? Because last time when we interacted with you, your bias was private banking, your bias was IT, and you were long pharma.
We are no longer long IT, in a sense we are no longer overweight IT. We continue to be long on pharma. Yes, we have trimmed our positions a little bit in the banking space, but that still remains a reasonable space. I'm getting a little bit more bullish on the PSU banking space now, given the valuation differentials, the fact that we have seen some stability in the asset quality issues, and given the valuations, I think some of those names are looking reasonably attractive. I think one other theme to play out is fairly high dividend yield stocks on the PSU side. We have some large names giving you between 4 to 6% dividend yields, and that is fairly attractive given the environment. And the valuations there are fairly attractive as well. So I think that is another theme one would really want to play at the moment.
Does one start buying SBI, wherein there has been disappointment quarter after quarter?
I would not want to comment stock by stock on any individual stock, but I think within the PSU banking space, one would have to be choosy. Not all banks necessarily warrant a buy. But having said that, I think there are enough names in the PSU banking space where the operational parameters are looking better, where the asset quality issues have stabilized or improved marginally, and the valuations are fairly attractive from whatever historical parameters one wants to look at. So clearly there are names which are available at attractive valuations which could give reasonable returns over the next year or so.
So the other big issue which has plagued the Indian fund industry is redemptions and outflows. Do you think the picture has changed, and when do you think outflows will become inflows?
Very difficult question to answer. I don't think the picture has changed meaningfully. Well, at the margin the redemptions may have slowed down a little bit, but very difficult to say when it will reverse. The retail investor has been pretty good at choosing the right asset class, I guess. They were in gold and then they were in fixed income, which has done very well. So yeah, maybe if the retail investor comes in, the equity class will start doing much better. So a tough question to answer. My sense is it will start happening once the liquidity in the system improves and the deposit rates in the system comes down. I think that will be the trigger one would want to watch before the domestic investor gets back onto the equity markets.
So Prasanna, the big question is that at a time when Indian markets are completely hostage to global liquidity, it's like this one-trick pony. If global money comes in, we go up. If global money gets out, we go down. Do you think we are skating on thin ice?
Yes, to an extent. That is very clear that we are very dependent on the global liquidity. That is something one will have to watch out for. If that money reverses, the markets will correct. Having said that, I think there is a reasonable base of the market, probably 10% to 12% correction from these levels. I don't think the markets can really correct further from those levels. Earnings will support a little bit of economic revival in FY14 will help. We'll hopefully see some election spending coming through. That will help. And the positive impact of falling commodity prices will obviously help. So my sense is, while yes, we are over-dependent on the global flows, as the macroeconomic situation improves during the course of the year, the markets will get some support from domestic investors, and our dependence in terms of the market levels being supported by foreign flows will probably recede as we go along in the next 6 to 12 months.
Justin, what about pharma? I mean, ex-Ranbaxy and Wockhardt, of course, the entire packet has held out very well.
Yes, it has. I think very clearly this was a call which a lot of investors made, that in case one has to look for safety, pharma probably was a much more attractive sector than FMCG given the valuation differentials, because growth rates were fairly similar. They were reasonably robust in the pharma sector as well. And I think that valuation differential has closed down a little bit, and the pharma stocks have done very well over the last couple of months. My sense is that this could continue. While one runs the risks of the situation which happened in Wockhardt or Ranbaxy, I think this has become a fairly obvious risk in the sector over the last 2 years. I guess every investor has to therefore assign whatever risk weightage one has to do to that. But having said that, I think this is an attractive sector with fairly reasonable valuations compared to some of the other defensive sectors, and good growth prospects at least for the next 18 to 24 months.
So Prasun, what is the bottom line? What could be the big turning point for Indian equities? Because we've been range bound. Whichever way I cut and dissect, Nifty has failed to scale up above 60-200. When do you think we will snap out of this trading range, something which has haunted us in last 2 or 3 years now?
I think the only trigger to watch in the Indian markets is the domestic liquidity. If and when, I guess it's a question of when, the domestic liquidity improves, the deposit rates start to fall, I think that is going to be the turning point for this market. And that is when you will start seeing a lot more domestic money chasing equities. You will see the real cost of funds coming down for the corporates. So that is one trigger I'll have to watch. Now, when that happens is difficult to call, because what can really trigger it? When will RBI really decide that they really want to do aggressive OMOs? Because that seems to be the only way they can increase liquidity in the system. So, so far very little to hold on, very little clues from RBI in terms of what their intentions are. But once that happens, to my mind, Indian market will really rally. So that is one trigger I'd really watch out for.
Prasan, let you go on that note. Appreciate you taking the time out. Always good chatting with you.